My name is Yohay Elam. I'm with ForexCrunch.com. I used to be a retail trader and a computer programmer. I founded ForexCrunch back in 2008. The site focuses on fundamental analysis, which I see as the most important thing moving markets, and I do touch on technicals when it's about entry points and things like that. So let's jump in. What we'll cover today: the current state of euro-dollar, the reasons for the recent rally, the state of the Fed, what's going on in the US economy in general, and then non-farm payrolls preview. And of course, questions and answers. Altogether, it's 45 minutes. I'll be presenting my presentation for about half an hour and then 15 minutes of Q&A. Just want to say in advance that we'll have the Q&A in the chat window and not in any other window. I'll say that again once we reach that stage. Okay, so if you look at the recent rally of euro-dollar, at least the screenshot I took earlier today, this morning, we had quite a rally. It's about 950 pips. The lines that I'm looking at from top to bottom are on your screen: 120, 118.76, 117.50, 116.50, 114.60, 113.73, 112.90, 112, 111.11, 110, and 108.50. These are sort of the long-term lines. So we've seen quite a rally from the bottom. The bottom has been 104.60, and so it's an uptrend if we look at it this way. But if we take one step backwards and look at the bigger picture, 1 year ago in early May 2014, euro-dollar almost touched 140, just before Draghi hinted about further rate cut. And so the general trend, as easy to see from this graph, is down. So of course we have the big question: is it a recovery, change of course in euro-dollar, or just necessary correction within the range? So what's behind the bigger picture? Well, monetary policy divergence. Draghi is looking one way, Yellen the other way. And let's get into the details of this. ECB is set to keep the rates low for at least 2 more years and is keen on implementing quantitative easing. So we have the interest rate in the Eurozone at 0.05 with a negative deposit rate, which is important, we'll explain that later, of minus 20 basis points, minus 0.2. And in the US it's also basically zero, but the Fed ended QE back in October and the rate hike is getting closer. Markets responded. So that's the big picture. But what about the recent rally from the lows, from 104.60 to 112.60 more or less? Now it's about 800 bips, depending how you look at it. Anyway, I count 3 reasons. Some hope for Greece, some good economic figures, not all, but it's all right, and turnaround in bonds. We'll get into that in depth soon. And of course, dollar weakness. We'll actually talk about everything here. So, Greece. Last time the peak of the drama was in late February. We had an extension of 4 months in the current bailout program. It was reached in the last moment, but we were supposed to reach an agreement by the end of April about the future, and time is running out once again. We're not that far from the end of June when the 4-month extension expires. In addition, Greece is running out of cash. We've seen the government take steps to get cash from local authorities and scrambling to pay pensions, and and Greek banks are in trouble, and each time the ECB is enlarging the money it lends as emergency loans to the Greek banks. The current deadline is May 11th. That's actually just Monday. So that's when we have a Eurogroup meeting. As we know from the Eurozone, deadlines are extended. Here we have a picture of Yanis Varoufakis, Greece's finance minister. He was recently sidelined from the negotiations. He's probably too much to cope with for his partners, too tough, too much lecturing. I don't know who's to blame, I really don't know. But we know that another guy's in charge, and we know that there is some progress. So, in general, nobody wants a Grexit, so that's why I don't think we'll ever see it really exploding, but it does have impact on the euro, everything Greece related. Why doesn't anybody want Grexit? Greece Greek exit from the Eurozone. Well, Greece needs to feel part of Europe. They're on the sidelines of the Eurozone, of the European Union with Turkey, long rival, and of course Russia. They want to feel part of Europe. Switching to independent currency, to the drachma, for example, can help in devaluing and boosting exports and tourism, but the transition could be very painful. The same thing goes for the other side. Germany needs needs weaker economies in the Eurozone in order to weaken the euro to help its own exports. And the Eurozone needs to be irreversible. It means that no country ever leaves, because that would open the door for other countries to leave. So far, we had only members joining in. It's a 19-country currency union. And of course, the danger of contagion, contrary to popular belief, it always exists. Once Greece is out and eventually it makes its way and the economy improves, other countries could follow, and nobody wants that. So how does Greece impact the euro? During the peak of the crisis in February, there was some kind of impact. It currently also has some kind of impact. It's not the main reason for the euro rally. Both sides in the past week or two are reporting some progress. So maybe it won't be May 11th, maybe it'll be May 15th or 21st, or the end of June, which is the final deadline, or maybe after the final deadline. Anyway, so far, the sides are always getting some kind of deal at the last moment, and I think this will be the case. And there are bigger forces moving euro-dollar. Let's look at the Eurozone economies, the second topic that is helping the euro recover. So we're seeing recently some positive surprises. Not always perfect, but let's talk about main points. So no more deflation. One of the main reason for the ECB's QE program, which is the biggest driver of the euro down, is deflation. Prices began falling. It was exacerbated by the fall in the prices of oil. But after oil stabilized and things are improving in general, we have 0% change in prices in April. This is still, of course, far from the 2% target of the ECB, but it's not negative. We had growth figures from Spain. We'll get other growth figures next week, and it's quite solid, 0.9% quarter over quarter. German unemployment continues falling. Confidence is higher in Germany and the Eurozone in general. We can see that in PMIs. We can see that in the ZU report in Germany and the IFO. And forecasts have been raised, both by German government, European Commission, and even the European Central Bank. What's helping the Eurozone? Well, quite a few reasons, but it's all related to the ECB, or most related to the ECB. ECB lending is somewhat reaching the real economy. So far, it helped only stabilize the banks. And now, banks are lending more money to real businesses, to mortgages. So it's the economies are waking up. It's reaching the real economy. All the interest rate cuts, negative interest rate, the programs, the TLTRO, targeted loans, everything is helping is beginning to reach the real economy. But the biggest driver, of course, is the weaker euro. If we have a weaker euro, we have more competitive exports from the Eurozone, and this is, of course, a help not only to the biggest exporting country, Germany, but to all the rest. In Spain's case, I'm based in Barcelona. It just couldn't get worse, especially Spanish unemployment that it's still around 24%, which is terrible, but it just couldn't get worse. So it's improving a bit. And specifically about inflation, we have stable and rising oil prices. Both Brent and WTI have been ticking higher for various reasons. We won't jump into that, but we're not seeing the free fall in prices that we've seen before. It took some time for the euro to react to the data, but after we had a positive surprise after positive surprise, we began seeing euro-dollar rise. And of course it's being helped by dollar weakness regarding euro-dollar. But there are bigger forces that are in play. Of course, the ECB QE, which I'm mentioning all the time, is the biggest force. But now it's working in mysterious ways, in different ways that maybe we had thought about. So, what's the ECB QE? Let's cover it quickly. From March, the ECB, the European Central Bank, based in Frankfurt, led by Italian Mario Draghi, creates 60 billion euros out of thin air and buys bonds. So it's the authority that prints the euros. It creates more euros, devalues the currency, and buys bonds of countries and as backed securities, but mostly bonds. The program is expected to last until September 2016, and if it's completed exactly like this, it will be an injection of 1.14 trillion euros, which is a lot of money. It could last longer depending on the consequences if inflation is still too low, but it could also be cut short if the ECB reaches its goal. That's the theory. And it began back in March, and it's all running already 2 months. So far, the ECB has no problems finding enough bonds to buy. Why is it euro negative? Well, as I mentioned, it devalues the euro. More euros makes it worth less. That's basic logic. And when the ECB buys bonds, the sellers are expected to use it in the real economy. This is monetary stimulus, and some of the money just goes out of the eurozone, and that weakens the euro. That's why it's euro negative. And of course, it can help. Weaker euro makes imported goods more expensive, raising inflation and avoiding the deflation vicious cycle. It prevents a case where people defer buys of goods because they expect prices to fall, and then factories produce less, fire people, people have less jobs, less money, and then they buy less stuff, and that's the vicious deflation cycle. In addition, a weaker euro makes exports more attractive, as aforementioned, so that's all good for the euro. So eventually, ECB QE is going to self-correct. We're beginning to see that because the idea of self-correction is that stronger inflation because of imported goods eventually leads to the end of QE and lifts the euro. And the weaker euro helps the eurozone economies grow more and, of course, makes investment more attractive. And also money flows into stocks and lifts the euro. So eventually it's a pendulum, it's self-correcting. But I think it's a bit too soon to see the self-correction. I think it's a bit small. So first of all, it takes time to see growth and inflation. In addition, for euro-dollar, the Fed is yet to hike. We'll talk about that later. And I think it's a bit more likely in the second half of the year. So I think it's too early to call this a big correction. But it's still a significant move of 800, 900 pips. It's not marginal. So I think another reason, the third reason in my list that we had, is that I think that the QE trade is beginning to backfire. So let's see how things are working. For months, money was flowing into European bonds in anticipation of QE. Draghi announced QE beginning. Hints were out there since September. So money was already flowing into European bonds because they knew that the ECB would begin buying them. And of course, it intensified with the successful execution and implementation of QE 2 months ago. But money flowing into European bonds, these bets were hedged with shorts on the euro. So if I'm an investor from outside, and I'm investing in European bonds and I'm taking a risk, I want to hedge my bet against losses in European bonds with, I can lose money on the currency itself, on the euro. So there were lots of shorts. These shorts also contributed to a lower euro. Of course, it wasn't the only reason, but this also weighed on the common currency. So now, the ECB, the European Central Bank, it has a good execution of this QE program. That's great. But where is the limit? What bonds does it buy? So it buys bonds with yields up to a negative deposit rate of 0.20%. We had the German bonds of up to 7 years that they had a negative rate, negative yields. And the ECB, if they didn't have a good execution of QE, they could have offered to lower the negative deposit rate. Okay, so instead of buying bonds with yields up to minus 0.20, they could have said, okay, we have now a negative deposit rate of minus 0.50, and to begin buying bonds up to this negative yield. But on April 15th, in the last ECB meeting, Draghi clarified that rates are not moving. Okay, he said yields are bonds. Interest rates have reached their lower bound, not for the first time, and and then just 6 days later, Bill Gross, don't know if you know him, used to be the head of PIMCO, used to be called the Bond King. He still has a lot of impact on markets. He said that shorting German bonds, shorting German bonds, they're known in German as bonds, are the short of a lifetime. But he also said you have to wait until September 2016, until QE ends. But when markets heard that, and with bonds already very expensive, with yields so low, especially in Germany, and with Draghi saying he won't lower the negative deposit rate, it means he won't buy yields that are too negative, markets didn't wait and began turning around. So from April 22nd, April 23rd, about 2 weeks ago, we had a change of course. And we saw a sell-off in European bonds. It means yields have gone up of German, Spanish, Italian, and of course Greek bonds, but basically everything became huge. German bonds were, I think, 20 basis points, and now they're about 74. So in relative terms, it's a huge rally in yields or a huge sell-off in bonds. And this the sell-off in bonds triggered a squeeze in the hedges that were on the euro. All the shorts began turning around. So the euro went up, not only against the US dollar, which is weaker, but also against the euro rallied, also against the pound, also against the yen. Across the board. Of course, Bill Gross is not the only person responsible for this rally in the euro, but he sort of he put his finger at the right moment. Just said you have to wait, which was eventually apparently wrong. So we had a nice rally in the euro against everybody, and let's explain again why I think it's limited. This is probably a big correction of the euro weakness, of the big bond rallies that was necessary. They reached the euro was extremely weak, and bonds were extremely expensive. But on the other hand, we have ongoing ECB QE that still pushes money out of the eurozone. That's the bigger picture. It just went a bit too far. We also have a negative deposit rate. That means that investors don't want to park money with European banks, or banks don't want to park money with the ECB. And this, I think, will continue weighing on the euro. So what are the things to look out for? First of all, the economic growth in the eurozone. Recovery is still fragile. We'll get GDP growth figures from Germany, France, and Italy next week, and for the whole eurozone, of course. And Draghi determination is still the key. He always says that for his optimistic forecast, new optimistic forecasts to become reality, needs full implementation of QE. In the last meeting, he was asked many times if QE is about to end, given its success, and he said, no, it's too early. He said something like, it's like a marathon runner running 42 kilometers in total. If he's asked after 1 kilometer if it's the end. And so it still has a long way to go, and printing of 60 billion euros per month, I think, will still have a negative impact on the euro, so it's just a correction, in my opinion. Now let's move to the other side of the Atlantic, because part of course, the picture of euro-dollar has been US dollar weakness. So, state of the Fed. Here's Janet Yellen, the chair of the Federal Reserve, the most powerful person, I think, in foreign exchange. In their last meeting in April, just a few days after the ECB, they removed forward guidance. That means they stopped saying we will not raise interest rates, patience, all these kind of things that accompanied us. Just the Fed will decide, of course, depending on the data. So rate hike can theoretically come at any time. The next meeting is in June. In addition, they did acknowledge the weakness in the U.S. economy. They said, of course, we had job growth, very poor job growth in March. Only 126,000 jobs were added. But the whole weakness in the U.S. economy in Q1, they see it as transitory. Ports were shut down in the West Coast. Oil was weak. Winter. Everything is to blame, more or less. So, in general, they contrasted the weak GDP that was released in the same day, and they remained positive. Okay, there is some weakness, but it's not too bad. That was the sort of general notion from the Fed. As aforementioned, they remain data dependent. The next meeting is only in mid-June. Until then, we have lots of data, 2 more non-farm payrolls. And this meeting in June is important because it's accompanied by fresh forecasts from the Fed and a press conference from Janet Yellen. At this moment, with all the weakness, I think a September rate hike is more likely, but of course, nothing is certain. There's also a meeting in mid-July, late July. This meeting does not consist of a press conference or fresh forecast. The Fed always said that every meeting is a live meeting, but I think that for a move so significant, such high magnitude as a rate hike after so many years, they will want to explain it and do it with a press conference. So I think at this moment, the September is a bit more likely. So if non-farm payrolls is not a disaster, September is on the cards. If the non-farm payrolls reports, this one tomorrow and next one in early June, are amazing, rate hike could still come in June. I think it's not totally off the cards, but we have a low chance of seeing that. If the data is less than okay, that means like in March or worse, a hike is expected only in December. I'm talking about market expectations, of course. So how does a rate hike in the United States impact the dollar? Of course, it's the most important thing. Foreign exchange, Forex moves mostly on rate hike expectations. The timing of the first rate hike has a big impact on the dollar. This matters a lot, even though it'll be only a symbolic rate hike, even though the balance sheet of the Fed remains huge after all the money they printed for buying bonds, all the 3 QE programs. And even though the pace will be extremely slow and gradual, they could hike once and then wait for a meeting 2 or 3. And after the first rate hike, things could change. But for now, the big focus of the market is when will the first rate hike be? That's the main focus. Recent US data and what's going on in the US economy. Why did I say I think it could be postponed? The rate hike is, we had this terrible GDP report. Q1 growth showed only 0.2%. That's annualized. That means if you compare it to other countries like the UK or the Eurozone, which report raw quarterly figures, it means it's only growth of 0.05% in the US. Anyway, it's almost nothing. It could be revised. We have 2 or more revisions to negative because the trade data for March showed a big deficit, and that could just tip the US economy into a squeeze in the first quarter, contraction. That's still not a recession. We need 2 consecutive quarters of downfalls for an official recession to be announced. All the figures have just been terrible. We had falling core durable goods orders. That's quite worrying because that reflects investment, that reflects the future. Manufacturing in general is quite poor. We have seen that in PMIs, purchasing managers indices, and other figures as well. Retail sales, most of the US economy is consumption, and retail sales were falling for a few months. They did bounce back in March, but it was less than expected. Consumer confidence is off the highs. It disappointed. The most recent figure was the Conference Board consumer confidence, which fell off the highs. And in general, after absorbing all this data, for how long can you blame only the weather for the trouble and say Q1 was terrible and Q2 was weak. Eventually, it hit the US dollar. But we have a few, if you call it green shoots or silver linings. Core inflation, that's the second mandate of the Fed, apart from jobs, is quite solid, 1.8%. Jobless claims, which we got today, came out better than expected in the past few weeks. So that's a positive sign. If we look at wages, which is also important for the non-farm payrolls tomorrow, we did see an improvement in the employment cost index. It's not the average hourly earnings that is the most important figure, but we are seeing some sort of second-tier figures that are related to wages, to salaries, which are improving. All in all, the situation is not too bad. The US economy is still a general positive trend, but it's still okay on inflation, it's still okay in jobs, and those are the Fed's mandates. But Q1 has been terrible. So let's look back at the previous non-farm payrolls report. It has been basically bad. A gain of only 126,000 jobs. After 12 months of gains of over 200,000, and especially 3 excellent months before March, December, January, and February, we had, that's a mistake, we had a negative revision of 69K, that was also bad, of course. An employment rate at 55.5, okay, that's excellent, but we had participation rate that is still moving up, but still quite low. Wage growth, on which I touched before, that's 0.3% month over month. That's okay. That was a bit better than expected. But year over year, salaries have risen only 2.1%. It's not the real acceleration that we're looking for. And a reality check with the real unemployment rate, U6, a measure that counts also discouraged workers, that showed 10.9%. So that's sort of it's better than it has been beforehand, but it's not so good for the economy in general. So what about tomorrow? What the expectations stand on a bounce back to previous gains. That's about 227,000. The data leading to the non-farm payrolls report was mixed. ADP disappointed with a gain of only 169,000 and a negative revision, but on the other hand, the ISM non-manufacturing PMI was okay, just marginally better than expected. So I think expectations remained around this level, 225, 203,000. The unemployment rate is expected to continue falling to 5.4%, but as we said, the participation rate is low, and average hourly earnings are expected to rise 0.3%. These are basically optimistic expectations for a bounce back after a bad month and general bad data. But let's see. So how can it impact the US dollar? If we have job gains back of 250,000, it's positive for the US dollar. It's business as usual, job gains as they were. It was only 1 month blip. It was, you can blame the weather, you can blame other things, and it's a one-off. It's all right. If we have another figure under 200,000, it's just negative for the US dollar. It's 2 consecutive months of falls. If it's somewhere in between, I think the wages, the average hourly earnings will have stronger impact. So, wage inflation, rises in salaries and money that people have in their pockets, is the source of core inflation. If you have on a consistent basis higher salary, you will consume more. If you have more money in your pocket because of a fall in energy, that could be temporary. So it's still subdued, as aforementioned. It's hardly above 2% year over year. It's not the levels at which the Fed can hike quickly. As aforementioned, 0.3 month over month is expected now. Wages rise relatively slowly, and they've been extremely slow recently. They rise when people are changing jobs or around the end of the year. But who knows, maybe they will accelerate now if we look at other figures like the employment cost index or the labor unit costs. So that's a figure to look at. So in general, if we have 250,000 or more and the headline non-farm payrolls, it's dollar positive, under $200,000 negative. In between, I believe it depends on the average hourly earnings. If it's 2.2 or more, it'll be good. If it'll be 2% or below, I think it's could weigh on the US dollar. We need stronger wage rises and stronger gains in jobs back to the previous strong levels, and not like we had last month. So what's next for your dollar, in my opinion? In the short term, I think we could have a positive non-farm payrolls report, and that could stop the dollar weakness. And next week we could have mediocre Eurozone growth, that could stall the euro rally. So I think we could see it turned around in the euro-dollar rally, and the correction of the correction could come. We had a correction with a rising euro-dollar within the bigger picture of the fall. Now we can have a correction of this correction. It's not too confusing. And for the longer term, I think that we'll have even lower levels. Euro-dollar will fall, I think, will fall under 1.10460. But once the Fed does lift the interest rate, and I think it'll take some time, but we could have some kind of a belated buy the rumor, sell the fact. Euro-dollar could start a nice recovery. As I said before, ECB/QE is self-correcting. We could have stronger growth later in the year. We could have also higher inflation. We could have markets beginning to expect the end of the ECB stimulus. But I think it's way too early. We could see a drop to parity or below before we could see a big comeback much later in the year. That's my these are my expectations, my bets. Okay, that's all I've prepared for you today. Now it's time for questions. What is the next direction of euro-dollar? I see we already have one question. How to understand euro short squeeze because of bond sell-off? Yeah, it's a bit complicated. What happened is this. We had investors buying Eurozone bonds, but on the other hand going short on the euro because they wanted to hedge, they wanted to balance their exposure. So they went short on the euro. The euro went down. Now we're seeing the other way around. We're seeing these shorts being covered. That means the euro, because less shorts are needed now because money is flowing out of Eurozone bonds. This is only one reason, but an important one to explain the current rally in the past 2 weeks or so. More questions? Any long-term targets for euro-dollar? Well, I think we could see the euro-dollar beginning to fall, and it could sort of touch parity in a few months' time. We're seeing a lot of market volatility, which is a great thing. And I think that until the end of the year, we'll see it back to the levels we're seeing now, and perhaps even higher. So what levels will the pair reach later this year? I can guess maybe we'll see it back to 120, but after falling. Well, in general, I hope we'll see a lot of volatility. Any long-term targets? Sir, would cable fall lower when your USD goes to 104, and could this then test the lows for the year? I think cable could fall, but because of the elections, because of uncertainty. Because if we don't have a government quite quickly, then it could hurt the pound. So markets don't like uncertainty. Without getting into UK politics, all the polls show a hung parliament, so that's I mean, for the short term that could hurt the pound. In the longer term, we've seen some weakening of the UK economy, and that could also hurt the pound. But if it's euro pound, I think it has room for falls, but repeat why euro short squeeze because of bond sell-off. Yeah, it is confusing. I'll try to repeat once again. So what we had from maybe May last year up to a few weeks ago is that there were expectations for the ECB to buy bonds. Now, if you see that the ECB is going to buy bonds, you want to buy bonds before the ECB. And then when the ECB comes in and buys more bonds, then you make a profit. So that happened before the announcement, after the announcement, and after the implementation began in March. So we had sort of 3 phases of rallies in bonds. That means lower yields. But if you're buying Eurozone bonds, that means you're exposed to the euro. And you want to hedge against that. You don't want to put all the eggs in one basket. So you go short on the euro. That means if all these if you are exposed to European bonds and the euro goes down, then you could lose money. You don't want to lose money, so you go short on the euro. And then if the euro goes down, you make money, and that sort of compensates. Now, that's what happened until a few weeks ago, and now we're seeing a reverse of that. So if I'm investing in a German bond, and now I'm taking profit on that bond, because I made a lot of money. I bought this bond back a year ago, and everybody else bought in, and now I'm selling it off. Now everybody's selling it off. Okay, so I'm selling it off, and I am no longer exposed to the euro because I took my profit on the German bond, and I'm not exposed anymore to the euro. So if I'm not exposed anymore to the euro, I don't need to be short on the euro. And if we had this sell-off also of euro shorts, and combined with other factors, that's one of the reasons that the euro strengthened. If it is still confusing, it's important to remember the other factors. Eurozone growth has improved. The US economy did deteriorate, so we had real fundamental reasons for euro dollar to rise. Just this spike, the last push, came from this sell-off of bonds and the short squeeze. I mean, about cable short term, but longer term, when euro USD reaches parity, do you see cable testing against US lows? Yeah, I guess it could go hand in hand, because you could see the Fed higher expectations in the US to raise the rates, and the dollar strengthening across the board, and euro weakening because of that, and also the pound weakening because of that. And together with uncertainty in the UK and a bit slower economy, we could see the euro and the pound weakening together. Basically, it's the main phenomenon in currency markets. The biggest mover is the US dollar, and not the crosses. So and changes in crosses are usually smaller. Even though I'm happy we've seen good moves also in crosses. When is the time to buy the German bond? Who has to open mouth for that? Not sure I understand the question, but I mentioned before that Bill Gross, he said that shorting German bonds, selling these German bonds, would be the short of the lifetime. But he advised to do that only in more than a year from now. He sort of touched it when that was one of the things that triggered the sell-off. When is a good time to buy German bond? I don't know. I don't follow this the European bond market so closely. I wouldn't advise on buying German bonds or selling them, so they were just too expensive even for the ECB, at least in the shorter term maturities. And we had negative yields up to 7 years. Okay, while we wait for more questions, I'll say thank you. Thank you to FX Trade, as always, for hosting the webinar. You're welcome to visit forexcrunch.com and listen to the Market Movers podcast. We have also podcast page. And these are my contact details. You're welcome also to download the iOS and Android apps. Thank you very much. Question here around about cable. Yeah, I think on UK uncertainty we could see another fall of cable to lower levels, but a lot depends on the result of the elections. If we have a clear outcome, outright majority for either of one of the big parties, we could see cable rallying even tonight. But that's a bit unlikely. If we have uncertainty about who's going to form the next government, then it could hurt the pound. In general, we're seeing some kind of weakness in the UK economy. But who knows which economy will recover from this slowdown quicker, the UK or the US economy? Any more questions? Anyway, good luck in trading. Whoever's trading tomorrow's Non-Farm Payrolls, it's always quite a, so to speak, dangerous event. And anyway, I'm glad we have so much action in markets. We had, this time last year was so boring. Markets hardly moved, and since September it has improved, and since the Swiss National Bank made its move in mid-January, we're seeing so much more excitement. And it's opportunity and risk, of course. Any last questions? An example of volatility, I think we've got one today with euro dollar moving quite amazingly, getting close to 114 and then falling around 150 pips. Okay, so if there aren't any more questions, I'd like to thank you all once again. To thank FX Trade for hosting the webinar. And I hope to see you guys soon. Safe and happy trading to all. And well, that's it. Good luck with your dollar, with cable, or with any other currency pair you choose to trade. Okay. Thank you. Bye.